INSEAD is hosting its 7th annual private equity conference here in Fontainebleau. Peter Cornelius, welcome. You are the head of research at AlpInvest, which invests in private equity firms mainly. You're one of the keynote speakers at this private equity conference this year. And my first question to you, I guess, is what is your sense of the state of the market today? Obviously, with the credit crunch, the complete collapse of the number of private equity deals and transactions, and many covenants being breached currently by former investments, it looks pretty grim.
Well, I think it depends very much on the individual market segments we are looking at. There are certainly market segments in private equity that have been affected very badly by the situation in the credit markets, notably large buyouts. That market is essentially shut. It has been shut for quite a while, in part because it is virtually impossible for general partners to obtain loans from the banking system or from the debt capital markets. So in the first quarter of this year, the total volume globally in buyouts was less than 20 billion, which would not have been enough really to qualify as a top 10 deal at the peak of the last cycle in 2006, 2007. We also see a decline in investments in venture capital, but at the same time we see a shift in investment activity towards distressed assets, and also, and very notably so, towards secondaries. Mezzanine is expected to pick up as the debt capital markets begin to recover and we see more deals again.
On the whole, though, this is not enough to qualify as a transfer. I mean, the nominal number of transactions has decreased, and maybe if people are doing a bit more distressed deals, it really hasn't been enough to substitute for the disappearance of a great number of deals. So in this situation, is the industry in a bit of a disarray nevertheless?
Absolutely. I think there is absolutely no doubt that the total pie of global private equity has shrunk very dramatically by about 60 to 70% from the peak. Now, the question is, of course, 2006 to 2007, was that really the right benchmark, or wasn't that really a bubble when we look at a longer-term trend, of course?
And as head of research, what is your answer to that question?
I think that was really a bubble with hindsight, given the extreme degree of liquidity in the debt capital markets and the huge amount of capital inflows into private equity funds. So we see a very dramatic decline in activity. The pie has shrunk, as I said, but at the same time we also see a different composition in the global private equity market.
Okay, looking forward now that we've set the stage, what do you see happening? When do you see the recovery? Is it going to be many years before we even see the IPO markets open up again? Or do you think it could happen sooner than expected?
I think we see some encouraging signs in the financial markets. The stock market has recovered from its low in mid-March. We see some activity in the debt capital markets again. So analysts have become more optimistic because of better economic data. However, I think we need to be realistic. It will take several quarters really before we see positive economic growth, before yield spreads decline to levels where it makes sense to finance buyout deals. And also we need to be realistic about the situation in the LP community in terms of the investments they can make in different asset classes.
There's a bit of an issue in your industry right now. You are an LP, a limited partner in the funds you invest in, and so for funds that were raised in the bubble years or just before the markets collapsed, a lot of money went in from limited partners, which has yet to be invested, and yet the general partners who manage the funds are getting management fees on the scale of about 2% per year for basically doing nothing and sitting out of the market. The overhang, the capital overhang, is about $1 trillion, I think. Is there pressure from LPs today to just say, okay, nothing's going to happen, just give us back the money, we can invest it in money market funds, but it'll be better than paying 2% management fees per year? What are you saying? What are you saying about this?
I think two things here. First of all, we work very closely with the GPs who spend increasing resources to work with the portfolio companies. So to protect the existing portfolio of companies is absolutely critical in our view. Although we do not expect defaults to climb to levels that have been reported in the press, up to 40 to 50%, it is very important for the GPs to spend a very substantial amount of their time with the portfolio companies. I think GPs remain active, however, in looking at new deals. The question is, can you acquire assets at realistic prices? And I'm afraid many potential sellers of assets remain rather unrealistic in terms of what they expect to obtain when they are selling. So a lot of GPs have actually declined to make new investments given the situation in the credit markets, given the level of valuations.
Does that justify giving them 2% of $1 trillion per year for doing essentially nothing but waiting out the storm?
No, I think no LP really likes to pay fees regardless of the situation. I think we are fees that are not related to performance is something the LP community doesn't like at all.
So what will come out of this crisis is maybe rethinking the business model of the relationship between LPs and GPs and making it more success-driven?
Well, we are hopeful that we get substantial power behind within the LP community to get better deals really with regard to our relations with the general partners. However, this is not the first cycle. We have seen cycles in buyouts, we have seen cycles in venture capital, and every time we had expected fees to come down and carry also, but in fact those have been relatively stable over these different cycles.
One last question, a note of optimism. I saw in a slide that you presented today that you show an inverse correlation between the state of the global economy as measured by GDP growth and returns that come from private equity investments. So basically you get the best returns when the economy is in crisis, is what you show.
That's exactly right, because well, one of the reasons is that there's less competition for deals. Asset valuations tend to be significantly lower in an economic recession, and so those GPs who can make investments typically find very attractive deals. There's a clear inverse relationship between the situation in the broader economy and returns in private equity. So I'm less concerned about book valuation changes. I'm really more interested in vintage year performance, and historical data suggests that 2009, perhaps 2010, could be pretty good vintage years.
Peter Cornelius, AlpInvest, thank you very much.
Thank you very much.